Alkaline Advisors. Thanks for joining. Today we will be going over a single family residential short-term financial model. So think of this as something you can use to value or help you understand the cash flows for an Airbnb property, a VRBO property, any property that you have where you are looking to understand how much money you stand to make with different rents per season broken out on average daily rates. So this is a fully dynamic model and it's very straightforward but very powerful. So you'll see there's only one tab, right? We've got the typical disclosure tab, which is just the standard disclosure we have in all of our models. And then we have the actual short-term template. So this tab is separated really into two sections. The first is the top section, which is the assumption section. So it's everything from here down to this debt section. And then underneath this is the cash flow section. So these numbers are all auto-populated based on the assumptions that you provide in the section above. And you'll see, right, it's calculating on a monthly basis and it's calculating for 10 years. So there are a lot of cool features this model has that I will be walking you through right now. It's pretty functional, and let's dig in. So as I mentioned before, the top section is the assumption section. This is where all of your inputs will be housed. And remember, the blue cells are the dynamic cells. These are the cells that you plug in your inputs, and these light blue cells drive the rest of the model. So try not to touch or auto-populate any of the cells with black text, or else these black texted cells that are going to auto-populate based on the formulas, they won't auto-populate if you manually override the formulas in here. So the top section is property overview. This is just generic information on the unit. Same thing with this outdoor amenities and utility section. This is also generic information. This is more so just for illustrative purposes, so that if you have a few models or a few short-term rental properties, you can have a couple of different models, and this will make it so you're not getting confused when you're flipping back and forth. But essentially what you do is you come down to the acquisition cost. You could plug in the purchase price of the unit or the home. What are your closing costs? So what percent of your purchase price are your closing costs? When are you acquiring the unit? And in this scenario, or for this model operates based off of the last day in the month that you plug in here. So if we made this 12/27/23, you'll notice that nothing changes because this is 12/31/23 before. And you'll see this year zero times zero, the period that you are acquiring the asset, that is going to be the last date of the month that you put in here. Then underneath, you've got the pre-launch holding time. So this is essentially the number of months that you will have the asset under management without generating rent. So during this pre-launch holding time, you will be spending money on your stand-up costs. So your repairs, your outdoor amenities, and your furnishings and tech. So essentially, right, you see this is $59,500 total. If you come down here, you'll see the stand-up costs total $59,500, and it's spread out over months 1 and 2, the first 2 months, because over here we said that the pre-launch holding time would be 2 months. If we wanted to spread it out over 3 months, we'd make it 3 months. And you'll notice now it's spread out over 3 months, and also you're not generating rent on the asset for the first 3 months because that's the downtime. Yet you are still incurring all of those expenses on the first 3 months. And same with the mortgage, right? In this scenario, which we'll go over in a moment, we currently have debt on the asset and we have to pay the mortgage payment months 1, 2, and 3, even though you're not generating rent. So you'll notice, right, you're at a running at a $1,700 deficit in terms of the operating statement for the first 3 months. In addition, you're paying $3,200 for the debt. So those first few, and right? We have got the stand-up costs. Oops. We have stand-up costs of $19,800 approximately per month. So for those first few months, you're going to be running at a negative value of about $25,000 before you start becoming cash flow positive. So then underneath this stand-up cost section, you could see we built out a cash needed to stand up the unit. So it shows you based on the fact that you have a downtime of 3 months, you need X dollars in utilities, Y dollars in mortgage principal and interest, and then Z dollars to cover your taxes and insurance. And then in addition, it shows what the total cash needed is. So this total cash needed to stand up the unit is the sum of the stand-up costs plus the cash needed to stand up for the utilities, mortgage payment, and taxes and insurance, which gives that total cash needed to stand up the unit, plus this total cash needed for acquisition, which is the down payment, closing costs, debt fees, and reserves. So when you combine that 73,000 and that 231,000, you get that 304,000. Now, obviously, this will be unique for your given scenario, but that's how it's calculated. So let's now move into the operating statement. First, we're going to talk about the operating income, which is this section on the left. Then we'll talk about the operating expenses, which is the section on the right. So because this is a short-term rental, we've given you the flexibility to break down the seasons in 4 different categories. We label them strong, normal, weak, and partial. But essentially, it's what are your 4 seasons, best to worst. And you can assign each season an average daily rate. So the average dollar per night for the unit. And then what is the average occupancy rate for that month that lines up with the season, right? So strong, we have 95% occupancy rate. Partial, we have 70%. And you can fill in the gaps based on your specific scenario. So once you have all the seasons identified with the average daily rate and the occupancy rate, then you move to the seasonal breakdown section where you're essentially assigning each month a different season, right? Strong, normal, weak, or partial. And obviously, depending on where your asset is, right? If it's in a ski resort versus the Caribbean, you're going to have a different classification for each month. Then underneath, you have the monthly operating income. Obviously, this is just an average. And then you have an annual operating income over here based on the monthly times 12. So you can see what your average daily rate is. This is an average of not taking into account actual days per month, but it's just an average of each average daily rate at the average occupancy as well. So next we have the operating expenses. And actually, before we go to the operating expenses, let me just show how this plugs into the model. So you'll see each average daily rate is assigned a different month. So these months, it's actually shown here. So you'll see month 4, this is April, May, June. If we go to April, May, June, you'll notice that April's normal, May is strong, and June is strong. So we go to April, May, and June. You'll notice that May and June are showing different amounts of potential gross rent. And that is because there are different days in each of those months. So, right, May has 31 days and June has 30 days, which is why there's a larger figure in May's potential gross rent than there is in June's. And that's how we try to make it as accurate as possible. And then same thing underneath, the vacancy is higher in May than it is in June because there are more days in May than there are in June. And that goes across the board, so each month has its own average daily rate based on the seasonal breakdown and the days in that month. So next we're going to go to the operating expenses. You'll see that it's pretty straightforward. You have insurance, tax, and you've got some utilities, electric, heat and gas, water, cable, technology fees, maintenance, and then HOAs. Again, the blue cells are the input cells. So for this insurance, it's a percentage. I think we tied it to a percentage of the purchase price. Yes, we did. So you can manually override this if you want, but it's just a way to calculate insurance. Then you have taxes. And the way we did taxes is we actually gave you a toggle between forecasted tax and current tax. So if you select current tax, you'll see it's 192. And that is because we have current property taxes loaded up here. And if you take that and divided it by 12, you'll get 192, right? 191.67. So you could either select current tax or you could do forecasted tax and just take 1% of the purchase price. And again, these are monthly expenses. And you load in your monthly expenses for your utilities, your HOA fees, maintenance costs. You have management fees, so presumably you'll have a management company operating your unit, and you can choose what percent of the management fee is calculated off of the effective gross revenue. So if you come down here, you'll see the management fee line item, 20% of that figure, which is the effective gross revenue. So it's the potential gross rent, which is the total possible rent you could get for that month, minus the vacancy, which gives you the effective gross revenue. And that management fee is calculated based off the percent that you input in the assumption here. So here we have 20%, and then whatever that effective gross revenue number is. Then we have cleaning fees. So you'll notice here we have cleaning fees of $150 per turn. Well, under the other assumptions box, we have assumed that the average nightly stay is 3 nights, which means that this $150 per turn, you're only paying $150 to clean the place every 3 nights. So if we made this 2 nights, you'll see that cleaning fee, it changes, right? Because now there are approximately, let's say, 15 turns in a month. And if we make this 10 nights, there are only really 3 turns approximately in a month. So then that changes as well. Also, we have something similar for supplies and welcome gift. If you choose to give your tenants, your residents a gift, you can say how much that gift is going to be. So again, we're trying to drill down as accurately as possible to identify your total returns. So underneath, we have a total monthly operating expense summation over here, and then we have the annual operating expense over here, and again, this is based on average, right? And then we have the annual cash outflows here. So this annual cash outflow is taking that annual operating expense, and then it's adding in the amortization payment. So this is the debt payment for principal and interest per month. So it's adding in this times 12, so you have your yearly debt service. So again, yearly debt service versus yearly operating expense. And then we also added in the yearly PMI, private mortgage insurance, if you have. And that's how you get your annual cash outflows of $121,000. And you have your annual operating income of $154,000. So in this scenario, you cover, right? Because this number is greater than this number. So a couple of other assumptions down here. We have the average night stay. We walked through that. We put 2. We can update this to 3. Again, totally based off your scenario. Annual expense growth. So every year, what percent are we assuming expenses are increasing? So in this scenario, we just have one variable, so one input. So we'll say 2%. So as expenses are increasing, obviously we have rent increasing as well. So let's hop up here to the growth assumptions chart. So this scenario is, or this assumptions box is giving you 3 different assumptions. It shows rent growth annually, what the property is appreciating at on an annual basis, and then cap rate, which we'll get into in a moment. So for the rent growth, this is every year, what are those rents growing at? So you'll see we have 3%, 4%, 4%, 5%. You can update this on a 10-year basis. Same thing with the appreciation for the asset in general. So if you buy it for $800,000, after 1 year, that $800,000 value is going to appreciate 3%. And then in year 2, that $800,000 value that had already appreciated 3% is going to appreciate another 2%. So that's going to help you identify what you can sell the asset at the end of the holding period. And you can see here, You can choose how long that holding period is calculated for, right? So here we're saying 108 months, which I believe is 9 years, right? Divided by 12, 9. Yep, so that's 9 years. And similarly with that appreciation per year, right? That's auto-calculated. So is that rent growth per year. So the way that we have that set up is in this operating income. Sorry, I'm hopping around, but I think this is going to be helpful for you to understand. Let's expand this. Okay, so you see the average daily rate. It's assigned based off of what we had dedicated up here to the specific seasonal breakdown. And then obviously when you assign a seasonal breakdown or a season to the month, it gives you that average daily rate that you assign. So with these rent growth figures, you'll see each year, starting year one, you're at, year one is what your average daily rate is today, but each year thereafter, you're growing at that rent growth figure. So what, the first figure was 3%, and then the next is 4%. So you'll see 3% growth to year two is 312, and then 4% growth on that 312 figure is 324. So if you have exact figures you want to use, you can manually override these numbers, right? But again, it just gives you more flexibility, and if you don't have the exact figures, you can just plug in these rent growth percentages per year. Okay. So sale date, you can choose when you're selling the asset. So right now we're saying we're selling it in month 108, which is year 9. If you make this month 60, that's year 5, you'll see down here the cash flows will happen until month 60. So month 60 right now, this is where the debt ends. This is where the sale of the asset is, right? Sale of cash flow. Sale for the asset, month 60, and then here is where your property level cash flows are. Actually, let me break that down really quickly. In the cash flow section, we have it separated into different categories. So the first box is acquisition assumptions. The second is the operating statement. So acquisition, it's pretty much your cost to get up and running. Purchase price, closing costs, and then stand-up costs. Then you have your total acquisition costs. Then you have your operating statement. So you have your income, and then underneath you have your expenses, and then you have your net operating. Net operating income down here. Then you have your debt section. So we haven't spoken about the debt section yet, but I'll walk you through it in a moment. We have the first segment is the bridge loan or the acquisition loan. Then we have the refinance loan. And then finally, we have the perm debt. So you technically don't need to use any of these 3 sections. And these 3 sections are correlated to these 3 sections. So the bridge loan, the refinance, and the perm debt. But we gave you the ability to essentially buy the asset with debt and then have 2 additional refinances. So I'll walk you through how to use that in a moment. But you'll notice in this scenario, sorry, I'm really running suicides on this Excel right now, going back and forth. But on this scenario, you'll see we've acquired the asset with 75% loan to value, 2% loan fee at a 4.5% interest rate. We're saying that the loan is amortized over 30 years or 360 months. There's no interest only period. And then we are refinancing in month 30. Right? We're saying that the private mortgage insurance is 50 basis points or 0.5% of the loan amount, and you're paying it for over the course of 24 months. Your principal and interest reserves is you just need 1 month's reserve that's being paid when you take out the loan, and then you are getting that back upon refi, which we're saying now is happening in month 30 because this refinance is toggled to yes. So if we toggle this to no, you'll see that even though you have the refi in month 30, because we're saying there is no refinance, we're just saying that you're paying off that acquisition loan at month 60 because that's when you're selling the asset. So if you make this month 100, you'll see this changes to month 100 even though this is at 30. But now if you toggle the refinance to yes, right, now you're refinancing in month 30. In month 30, if you make this month 40, you're now refinancing in month 40. And then same thing here, right? It says that you could say your payoff or your next refi is in month 20, but you're actually not refinancing because this is toggled to no. So the difference is you're just paying off this second or this first refinance 60 months after taking the refinance out, right? Because 60 plus 40 is 100 and your total sale month is 100. So if we update it, which again, right, you have that first refinance, you're taking this loan out in time 0, you're holding it for 40 months, and then you're doing the refinance in month 40, and then you're holding this because you have no refinance thereafter. You're holding this piece of debt for 60 months thereafter. But if we toggle perm debt to yes, then this will factor based on the payoff date. So you can even make this 100. You'll see this is only 60 because it says you're selling the asset in month 100. So all of this is just calculated. I'm probably digging too much in depth, but all of this is calculated to reduce manual user error, to show you, right, what your refi is and how much your payoff value is. So what are you paying at this time to pay off that debt that you currently have outstanding? So again, if you make this 30, right, then you'll see that you have 40 months. You're taking a refi on the current asset. I'm sorry, you're acquiring the asset times 0, and then 40 months after acquisition, you're doing your first refi. 30 months thereafter, you're doing your second refi, which means total you have 70 months, right, where you have a span of 70 months until you're doing your final refinance. So you'll see that payoff date is 30 months because that first 70 months plus 30 months is 100, and that's when you're selling the asset. So just to kind of conceptualize that, you'll see the bridge loan, the refinance, and the perm debt. You have your bridge loan here. You're holding that, what did we say, for 30 or for 40 months. You're paying this off in month 40, right? This is when you're taking that refinance in month 40. You're going to be holding this for 20 months. I'm sorry, 30 months, whatever our input was back there. And you'll see, and now in month 70, you take out that final permanent debt, and then that's going to be outstanding until month 100 because that's when you're selling the asset. Right, so what did we say? You come back up here, you'll see, right, yep, 40 months, 30 months, and then this final is for 30 months or that month 100. And all of these auto-populate, so it tells you what your payoff value is based on an amortization schedule, which we have in this. It's actually hidden, but you can see here what the amortization schedule is for those loans. Scrolling back up, you have the first loan, the second loan, and then that third loan. So that's what's calculating, what percent of the loan is going to pay off interest, what percent of the loan is going to pay off the principal, because obviously when you pay the principal is essentially you paying yourself, and you're just taking value in the asset. So, okay, so that's almost everything. Finally we have the sale method. So when you're selling the asset in month 100 in this scenario, we have your value at sale being dictated by either the sale method or cap rate method. So either by the appreciation method or the cap rate method. So if we do it by appreciation method, you'll see we have these assumptions, and this is just what the asset is growing at an annual basis. If we do it based on the cap rate method, the way that let me go back for a second. Appreciation is very straightforward, right? If you have a property, it's $100,000, it appreciates 1% every year. Well, in 1 year after you acquire the property, that new value will be $101,000, right? Because it grew 1% from the time you bought it to a year later. The cap rate method is how most commercial real estate is valued. And essentially, you're valuing the net operating income. You're valuing the cash flow of the asset. So it's taking the NOI for a year period. So that's the revenues minus expenses, not inclusive of the debt service. It's the revenues minus expenses. So in this scenario, right, if we look at the annual summary, it would be this figure right here for year one, right? It's the revenues minus the expenses gives you the NOI. You take the annual NOI and you can divide this by a cap rate, and the cap rate is going to be, you're essentially valuing the cash flows. So you divide it by a cap rate, and then that that number that you get of the NOI divided by the cap rate gives you the value of the asset. So in this scenario, we say that we are valuing based on appreciation, but we can toggle based off of cap rate. And then if we toggle based off of cap rate, you'll see, scrolling down here, it shows you what the property sale value is based off of the cap rate method. So based off the fact that we are generating revenues every month, what do those revenues look like? And how are you deriving that value? So I don't know if that makes sense. I don't think I did the best job of explaining it this go around, but essentially we're finding the net operating income at a given year and dividing it by the cap rate that you have here to derive the value of the asset. So here, based on the cap rate we have listed and the net operating income of the asset, you'll see that the value are these figures. And you could see how that differs. We have what, 800,000 and then 1 million, 1.3 million, how that differs based on the general appreciation method. Or it's 800,000, 824,000. So that's a good segue into this box over here. This is showing you what dollar figure of equity you have on your asset versus debt. So obviously, and then we have the refinance is factored into this as well. So you'll see the added value is based on the appreciation of the asset. The total value is that total value based on the appreciation of the asset. And you'll see here, right, you have 200,000. You're getting more and more equity into the asset. You have 288,000 in year 3, and that's because the value of the asset's appreciating. So that the value piece that has been appreciated is now considered your equity, but B, you're paying off some principal, so you're paying yourself, so you have less debt on the property and more equity. But in year 4, you'll see we increase from 288,000 to we decrease the amount of equity you have in the project from 288,000 to 241,000. That is because we refinanced in this year. So you'll see you have 25% equity, you build up to 33%, and then you drop back down to 27 because the refi, build up to 30, drop back down to 25 because of the refi. And that's showing you, again, the added value as a percent. It's showing you the percent of equity you have on the project and then the debt percentage you have. And these figures, it's the last month of the specific year, unless you are in the year of sale, then it's actually the period of sale. So in this scenario, right now we're selling in year 9, I think exactly year 9, which is month 100. But if we made this 105, right, you'll see this is 376,953. Now it's 406,167 because we have it for a few extra months. And then finally, you have the return on equity. So this is just showing you what is your NOI versus the amount that you have outstanding. This return on equity calculation is taking the net operating income. It is subtracting out the mortgage payment, and then it's dividing by the total equity that you have outstanding to give you the return on the equity you currently have on your project. So what's the NOI based off of the amount of equity you have in your project? Okay, so over here you've got the acquisition assumptions, right? And the operating statement. This is the same thing as the cash flow section below, but this is based on an annual basis, not a monthly basis. So these figures are the exact same. That 975,906 matches with that 975,906. And all of this is auto-calculated, right? This last month, or I'm sorry, this last year 10 annual snapshot of the operating statement, that doesn't flow to the total property level cash flow. That also is there for illustrative purposes. It only flows if you are, depending on what your total monthly amount is, right? So if you sell earlier, right, you could sell in year 5. You'll see now, right, if you sell in year 5, that 404,613 equals at 404,613. And then you have the IRR, internal rate of return, the return on investment, so ROI, or the equity multiple. And this is at a property level with debt. This is at a property level without debt. So you'll see obviously the return, you have more profit without debt, but your IRR, your ROI, and your equity multiple are going to be much less because you don't have debt on the project. And that's pretty much it. You've got some basic property level returns and metrics up here. So it shows you what the total sale price is when you're selling the asset, what your total profit is, what your return on investment is, your cash on cash return, break even. So what is that break even date? Here we're at month 42. That's right. If you change the purchase price to 600,000, you'll see this goes to month 39. Everything changes automatically. So monthly profit goal. So this is saying, look, if you say, look, I want to make $1,500 on this investment per month, then over here it tells you what you're above or below your profit goal. So you're above your profit goal, $2,200. So if you make this 0, it shows you what your average total profit is per month, $3,700. You can make this 5,000, and then you'll see you're actually below your profit goal. So we'll keep that 0 for now. It shows you what the equity multiple is, your IRR, your ROE at sale, and then your night coverage number. So on average, you need to cover, you need to rent your unit out about 20 nights per month to break even. And this is going to change based on the seasonal breakdown, the occupancy, the price, and then how you categorize each month. And then it shows you your debt service coverage ratio. And this is for the initial loan, right? It's your NOI divided by your debt service, and all this can help you just get a better sense of kind of where you lay out and what you might need to show lenders in order to get the project financed. So I think that is everything on this sheet. Feel free to reach out if you have any questions or if there's anything you'd like for me to explain in further detail. But yeah, if not, I'm going to sign off, and I really appreciate you spending the time to watch this video. And with that, again, Spencer Correnti from Alkaline Advisors, and hope to hear from you soon. So have a great rest of your day.